After a difficult 2022, bond investors should be rewarded with more opportunities in the year ahead. We expect the global economy to face headwinds with a modest recession in 2023 across developed markets as central banks battle to contain inflation. That said, a soft landing is also plausible. Consumer and business balance sheets are strong, with elevated cash reserves. Pandemic-related supply constraints created large order backlogs, pent-up demand, and margin expansion, which are all likely to support business activities. China's reopening may also provide a tailwind to the global economy. In terms of asset allocation, we believe any recession could further challenge riskier assets such as equities and lower quality corporate credit. But we continue to see a strong case for investing in bonds after yields reset higher in 2022 and with an economic downturn looking likely in 2023. Generally, we are focusing on high-quality fixed income sectors that offer more attractive yields than they have in several years. At the same time, we are preparing portfolios to navigate with flexibility in case of a more severe downturn and to have liquidity to take advantage of emerging opportunities from changing expectations. With the end of the zero-COVID policy and faster-than-expected economic reopening in China, our baseline 2023 growth forecast for the country is between 5 and 5.5%. While we expect some short-term disruption, a stronger growth rebound should follow, likely late this quarter or early in the second quarter. China's recovery will be led by pent-up consumption demand, especially in the service sector. Indeed, travel-related indicators and mobility data have already bounced back strongly, pointing to positive momentum in retail sales and consumption. We expect China's consumer inflation will rise from 2% in 2022 to a baseline of around 2.7% for 2023, which is still benign and below the official target of 3%. On the property front, while housing-related indicators remain weak, the market may stabilize over the course of this year after a raft of coordinated policy measures, particularly for the stronger developers. From a growth contribution standpoint, housing investment can pose more of a flat impact in 2023 versus a major drag in 2022. Macro policy will likely stay supportive in the first half of the year and then begin to normalize. Our key policy projections include continued credit easing to support small and medium enterprises, the property market, manufacturing, and green investments, front-loaded fiscal policy to support infrastructure, and continued relaxation in regulatory policies in sectors such as housing, education, tech, and gaming in order to stabilize growth. We are positive on China's recovery in 2023 because its economic cycle tends to be policy-driven. As laid out by President Xi and his team at the Central Economic Work Conference in December, China's economic agenda will be focused on one thing this year: growth. One area of headwinds to watch is the export sector, which has seen a sharp decline in demand in some of the major developed markets. Despite the global slowdown, growth is expected to remain relatively resilient in many Asian markets in 2023 as the recovery from COVID-19 continues. China's reopening will also be marginally supportive, especially for Thailand and Malaysia. Even though headline inflation across the region should continue to fall from its peak due to lower energy prices, core inflation remains high and sticky. As supply constraints further ease, core inflation could start to fall, but we may begin to see demand-driven pressure that have been absent thus far. In some countries, such as Thailand and Malaysia, a relatively weaker external balance position compared to 2022 could put pressure on central banks to continue with their policy normalization. With the exception of Indonesia, most countries in the region have shown no signs of reducing their deficits, and we broadly expect no rate cuts. For 2023, we expect duration turning to an underperformance but posting currency outperformance in Asia, reversing last year's trend as the region's growth inflation dynamic diverge from the rest of the world.